Hello and welcome. Good morning to a new Friday. I'm Ankita Saxena and with me is Snehi Shah. Good morning to you, Snehi.
Hi, good morning, Ankita.
So, Snehi, we did see the US markets rally yesterday, a positive handover coming in there on the back of earnings. But there's also data points that came out of US, which is very surprising because, you know, the GDP numbers came in lesser than expected and the jobless claims it shows a resilient labor market. Despite that, we did see a positive outcome in the US markets, primarily on the back of earnings. Take us through the details and all the number crunching.
All right then, so the US stocks finished higher as strong results from Meta platforms boosted tech-related names. The Dow Jones Industrial Average advanced 524 points and the Nasdaq Composite also jumped 2.4%, while the S&P 500 climbed almost 2%. And the Dow Jones and S&P 500 notched their best day of gains since January. So that's what was happening on the US market primarily. And Nasdaq jumped 2%, posting its best day since March. And S&P and Nasdaq are on pace of a second positive week. Now Dow Jones and S&P 500 have notched their best day since January, and Nasdaq is also doing pretty well, and Dow is also on pace for its fifth positive week. S&P and Nasdaq are on pace for the second positive week, and all of this was primarily boosted by Meta that posted really good results, and there was an uptick of almost 14% in their quarterly revenue, and this was topping all the street expectations that was all the estimates and expectations that were issued for Meta. And stocks on the US Wall Street rose despite weaker than expected GDP data. The US economy grew 1.1% in the first quarter, while economists polled by Dow Jones and all other polls on the street were expecting a growth of almost 2%, but that was slightly under expectations. So despite all of this, investors moved on. They did not look at this data, and all the strong results on Wall Street boosted the US markets.
All right, then let's also take a quick check of how the European markets perform. Now, as I mentioned, Snehi, that despite a strong, Meta shares jumping in trade and strong earnings coming from all the tech players, the US economy is really, probably headed towards a stagflation, is what the experts are believing because of the weaker than expected US GDP data, as you mentioned. But even the jobless claims, if you look, the jobless claims came out to be, if you look at the numbers there, the jobless claims were also came in at 230,000 last week as opposed to the estimates of 248,000, showing a really robust labor market, so which means that the rate hikes haven't really had an impact. It's just that the inflation is going up, but the economy is still pretty much, slowing down. So let's look at the where the crude is at right now. And crude prices have steadied, powering losses from the previous sessions after a top Russian official said that the global oil markets were balanced. Russian Deputy Prime Minister Alexander Novak said OPEC Plus does not see the need for further oil output cuts, but is always able to adjust its policy. Now, Russia, remember, is a part of the OPEC Plus group of oil producers that had announced a combined reduction of around 1.16 million barrels of oil per day, a surprise decision that the US had condemned and described as unwise, and which had sent the oil prices higher. But we did see the oil prices come off post that, primarily on the back of recessionary fears and the lack of demand. So Brent crude well below the $80 per barrel mark. It is currently trading at $78.2 a barrel, and WTI at $74.67 a barrel. And well, we also have experts joining us on the situation with crude. Let's take a look.
I agree that over the upcoming weeks, don't expect anything radical. Expect range-bound trades. Whenever something positive happens, it will be slapped back by another piece of macroeconomic news. I would just add to what Amrita has said one thing, and that is that the market has kind of lost trust in OPEC Plus being a reliable provider of information, because they say OPEC production cuts. But then you look into the actual exports that Saudi Arabia is exporting, and you don't really see them.
I think it will be volatile for sure. And to your question about supply demand, I mean, I do agree with Victor. The physical market is strong, and like I was saying, we are drawing stocks counter seasonally. That doesn't mean oil prices will go up anytime soon. I think this quarter in particular, with all the macro headwinds, you're probably going to get prices remain range bound around $80, right? Trading in the 70s, trading in the low 80s for Brent crude. Second half of the year, we are expecting crude prices to go above $100 per barrel because we have massive stock draws, right? The OPEC plus.
All right, so that's the word coming in from experts on crude and where they see prices headed. But let's see all the important cues to watch out for in trade today. And Ultratech Cement is going to report its earnings today. And among companies that are turning ex-dividend, you've got Sanofi India, HCL Tech, Jindal Stainless Steel, KSBL Limited. And on the corporate action front, you've got IndiaMart. The board of IndiaMart is going to meet to consider bonus issue today. So that's all the important cues that you need to watch out in today's trading session.
Then we did speak about this at the beginning of the show, but let's get into the granular details of what happened in the US market yesterday. Now, the focus is on the macro picture. Growth in US slowed considerably in the first 3 months of the year as the economy grappled with pressures stemming from the interest rate increases and inflation. GDP rose at 1.1% on annualized basis in Q1 versus the Dow Jones expectations of 2%. Meanwhile, as companies continue to announce layoffs, the number of Americans filing for unemployment claims declined to 230,000 people filed for claims. This is a downfall of 16,000 versus the previous week.
All right, let's move on and look at what Amazon did with their results. And Amazon delivered a beat in their Q1 earnings. Resilient demand coupled with company's cloud services business boosted revenues in the quarter gone by. The online retailer reported a profit of $3.2 billion. Meanwhile, it was a different story for tech major Intel, which reported staggering losses in their first quarter earnings. Company swung a net loss worth a whopping $2.8 billion versus a profit of $8.1 billion same time last year.
And German banking giant Deutsche Bank posted a solid set of earnings in Q1 amid a time when banks in the US and Switzerland see resuming a quarter increase in income. The results also mark the lender's 11th consecutive quarter of profit, marking its longest streak after years of losses. However, despite a solid Q1, the lender has announced it will lay off 800 employees in the new cost-saving drive.
And staying with the job cuts, global apparel retailer giant Gap has announced that they will cut as many as 1,800 roles in their second round of layoffs, joining a slew of companies who are downsizing their workforce on the back of inflation. Do remember, earlier the company eliminated 500 roles across departments amidst its battle against the weak financials.
And bad news for Singapore residents, a property tax in the city set to be hiked amid inflationary concerns. The government said both local and foreign buyers of residential properties will now have to pay higher additional buyer's stamp duties. The changes will take effect from today. Do remember, this will be the third round of cooling measures by Singapore following previous similar moves.
All right, then with that, let's slip into a very short break. Don't go anywhere, we'll be right back.
Welcome back. Here watching Market Cafe. Now, before we begin with the rest of the news flow, let's quickly take a check of the Asia markets. Now, Asian markets are also taking a cue from the US markets. The positive handover that came in from the Wall Street, primarily on the back of the big tech earnings that were a huge positive, and Wall Street clocked in one of their best days in the year. Post that, and of course, we are seeing the impact on the Asia markets as well. We do see also we have the Nikkei up almost 0.4% in trade, and that is on the back of the fact that Bank of Japan will be concluding their policy meeting today under the new governor Ueda, and the entire street is waiting and watching for that outcome to happen. And on the back of that, Nikkei is up 115 points. Kospi also in the green, up 0.4%. ASX 200 is up 0.3%. Shanghai, however, is bucking the trend, is largely flat in trade, up just 2.7 points. And if you look at the US futures also, US futures have also slipped in the red. US future is in the red. We see S&P 500 is down 0.1%, Dow Jones is down 0.1%, and so is the Nasdaq. So US futures currently in the red, but SGX Nifty, as you can see on the screen, is up 62 points, or up 0.3% in trade. So largely a positive handover coming in there, Snehi. We could expect a positive start for the Indian markets as well.
Right, as of now, SGX Nifty indicating a rather muted start of 0.3%. But with that, car maker Citroën is all set to enter the Indian market. Citroën is working on a new strategy of more models and dealership expansion to get a foothold in this market. The French car maker has today revealed its all-new C3 Aircross, a mid-size SUV which has been designed and developed in India. ET Now's Sumit Chaturvedi caught up with Thierry Koskas, Citroën's global CEO, in this exclusive conversation. Let's listen in.
The C5 Aircross, a big SUV to position the brand, I would say. And then we are rolling out a strategy with 3 cars based on a platform designed in India. So the first one was last year, C3, a small hatch. Today we present a mid-size SUV, C3 Aircross, and there will be a third vehicle to come later next year.
What about the Indian market? Well, you're present in India where with biggies like Maruti Suzuki, they are there. Maruti announced yesterday 1 million additional capacity. What about your overall experience so far in the Indian market?
Well, India is probably the most competitive market in the world because, first of all, the costs are the production costs are very competitive, and also, as you said, there are big competitors that are well established. But I think that Citroën has a particular role to play in this market because we offer unique features with our cars. Particularly, the driving experience is great. When we look at our cars, C3 and today C3 Aircross, the roominess is absolutely great. The comfort is really part of the DNA of the brand, and it's also a key feature. And if you take the new C3 Aircross, that will be the only car in this segment that offers a 5+2 seats capacity. So overall, although we are one of the latest newcomers in this market, we have exciting features to propose to the customers, and that's why we think that we can really become one of the big players of this market.
What about your journey so far in India? Are you satisfied with the journey so far? And if you want to have some changes here, what changes would those be?
Well, since we launched C3, we sold more than 9,000 units. We have today a limited network of 30 dealers, but the plan is obviously to extend that rapidly. We wanted to start on a steady growth because we wanted to ensure that the business model is solid and everything we do it well. So that's what we did at the beginning. As we are now introducing a second car, we will double the number of dealers, so more than 60 by the end of the year. And next year, you will have 100 dealers at the end of next year. So we will cover not only the major cities, but also smaller cities, so a better coverage of the market with new models arriving every year. So nothing to change. We are in line with what we expected, but it's just a question of growing steadily in the market.
About your electric car plans, you already have an electric car here, which costs ₹1 million, over ₹1 million. There's plans to bring a car cheaper than that because MG Motors in India has brought a car which is cheaper than that few days ago. So any plans to come below ₹1 million section?
Well, actually, what we want to do is to give credibility to electric cars. It's obviously a new segment in India. We have great hope about this segment because we think it will develop rapidly. And the point is, we want to have real cars, credible cars, when we start electrification.
Okay, so that's the word coming in from Citroën CEO on their foray into the Indian market.
Welcome back. You're watching Market Cafe with me, Ankita Saxena, and with me is Snehi Shah. This is that time of the news where we go domestic, and Godrej Consumer Products is the stock that will be in focus today, as it has confirmed that it will acquire Raymond's consumer care business in an all-cash deal for rupees 2,825 crores. Now, the deal is expected to be completed by 10th of May. The agreement includes acquisition of Raymond's consumer care business, which includes men's grooming brand Park Avenue, Kama Sutra and deodorant KS Park Premium, among the others. And we also have my colleague Anurag Joshi, who's filed in the report on the page from the management.
Lifestyle to real estate conglomerate Raymond has started a significant revamp of its business operations. Raymond has sold its FMCG business, which includes the iconic Kama Sutra and the Park Avenue Deo brands, to Godrej Consumer Products for 2,825 crore rupees. Raymond has plans to demerge its lifestyle business into Raymond Consumer Care, which is a division of Raymond Limited and was owning the Kama Sutra and the Park Avenue brands. Now the lifestyle business will be demerged along with the real estate business. So Raymond Consumer Care will be holding the lifestyle business, and Raymond Limited will predominantly be a real estate company. Now Raymond has manufacturing plants in Aurangabad, which the company will retain under the agreement with Godrej, and will supply to Godrej Consumer under the arrangement agreed between the two companies. The plan is to get Raymond Consumer Care listed over a period of 12 to 14 months and be a net debt-free company at a group level for both Raymond Consumer and Raymond Limited.
Okay, Anurag also managed to speak to the managements of both Raymond as well as Godrej Consumers, Gautam Singhania and Amit Agarwal. So listen in to an excerpt of that conversation.
What will be the promoter contribution to the lifestyle and real estate business?
100% of my equity holding in the consumer company, I am leaving back in the company. I'm not taking a single rupee out of it. So my 50% of the sale proceeds will stay in Raymond Consumer Care, and as a promoter, I am putting 100% of my sale proceed back into the business.
So you're putting it back into the lifestyle and the real estate business?
Absolutely. And which is a very strong statement to show my commitment and belief in what the company will do.
For the 1,400 crore rupees, can you give us a sense about the breakup? How much would be this 1,400 crore rupees that the promoters should have invested, that 1,400? Can you give me a sense of the breakup about how much is going into lifestyle, into real estate?
Actually, we have to understand the 1,400 crore is the sum of two promoter contributions into the business. The first one of 350 crore was done in 2019 when the land of the promoter sold. The second is this, which is 1,000 plus crores, which is the promoter share on the sale of FMCG, which again goes back into the lifestyle business. So to that extent is this 1,400 crores. So you cannot define whether this is a business, the 350 crore what we put in 2019 was relating to lifestyle or for the reality business. It was Raymond Limited.
And you also spoke about the 100% promoter contribution. I mean, can you give an idea about that?
100% promoter contribution means whatever share of the promoter on the sale proceeds, 100% of that proceeds has gone into the business. It is not 100% of the value because the promoter held only 49%. So whatever the value coming out of the 49% has been put into the lifestyle business in RCCL.
It's a full cash deal and we'll make the payment quite quickly. We're figuring out between our cash on our books and the amount of money to borrow, but it's quite easy for us given our cash generation situation in GCPL. So that one we're figuring out over the next few days what the right balance is. But it will be an all-cash deal and it will be consummated pretty quickly.
All right, then we also have market expert Harish Bijur, who is weighing in on the synergies of this deal. Let's go across and listen into what he had to say.
Well, firstly, it's an interesting acquisition for Godrej because I do believe Godrej is cobbling together a whole set of brands aiming for inorganic growth in a big manner. When it comes to Raymond, I do believe Raymond has a core competence and has a non-core competence arena. The core competence arena has typically been, textile and everything that Raymond does with its famous or infamous line about the complete man. Now, when it comes to items such as, condoms and certainly, perfumes, the brands that have been built through a kind of a peripheral distribution reach. And if at all, Godrej is going to do anything, it's going to deepen that reach. And I think that's what this bet of a big valuation for Raymond, Consumer Product Group is concerned.
Okay, so that's the word of experts coming in on the GCPL and Raymond deal. But moving on to the earnings from the IT sector then, and Wipro announced its Q4 numbers well below what the street was penciling in. And the board has also approved a buyback worth 12,000 crore rupees at 445 rupees a piece. My colleague Anisha is here to give us a breakdown of the numbers. Hi Anisha.
Well, it's a weak Q4. To add to that, it's a very weak guidance coming in for the Q1 of coming year. The only silver lining, if at all, is the fact that the buyback announcement has been better than what Street was expecting. 12,000 crore worth of buyback at 445 rupees a piece as compared to the expectation of 9,500 crores to 11,500 crores. Having said that, I am expecting there's going to be either, estimate cuts or downgrades coming in on Wipro because they are talking about a Q1 decline of anywhere between 3% to 1%. The street was expecting there is going to be perhaps a decline of 1% to a growth of 1% for Q1 of the coming year, but there's a big decline that they're pointing out too. This is coming after the weak Q4 performance as well, because if you look at the numbers for Wipro in the quarter gone by, the constant currency actually declined by 0.6%. Street was expecting there's going to be a decline of around 0.3-0.4% thereabouts. Separately, if you look at the dollar revenue as well, that's come in line with expectation broadly at 2,820 crores, but the profitability again has managed to miss the street estimates a tad bit. However, the attrition has cooled off substantially. It's now down to 14.1%, and the deal win continues to be healthy, but it's the weak guidance which is coming in which might worry the street a tad bit as far as Wipro is concerned, but the buyback is a bit of a sweetener.
Also, let's go across and listen into what the Wipro management had to say.
Yeah, for sure. The guidance for Q1 probably acknowledge two elements. The first one is definitely the fact that we continue to win in the market. That, as I said, the performance on bookings is good, and that we continue to increase, the volume of our backlog. The pipeline, by the way, continue to be strong, and we will most probably have another solid performance in bookings this quarter. And then we see on the other side also a certain continuation of we've seen certainly in the quarter a reduction of the volume of discretionary spend. It's been true in particular in two sectors, banking and financial services, and in technology. And probably that, it's not necessarily a change in I would say the volume of business, again, is the good one. We haven't had any termination. We haven't had any, one-off event. We haven't had any particular abnormal situation with any client. But we are certainly seeing, in those verticals in particular, reduction of this discretionary spend that is slowing down and some of our revenue progression in some of these accounts for Q1.
First of all, I think that all the teams at Wipro did a fabulous job in Q4 of maintaining margin where we were in Q3. So we kept the margin flat. We had some additional investment in form of travel, which was very logical given the deal activity that we had during the quarter. But we improved our utilization by 1.7 percentage points, which helped mitigate that higher cost by superior gain in terms of bench utilization. Going forward, our priority, as you can imagine, is around revenue and how do we get the growth, the steady state growth back as early as possible, and hence we will continue to work on our cost levers, and we'll try that we remain around the range that we have delivered in previous few quarters. And for priority right now is to get back to the revenue growth, and that's what we are working on.
Okay, so that's the word coming in from the management at Wipro on their Q4 numbers. But keeping it with the earnings from the tech sector then, and mid-cap IT company Tech Mahindra saw a 12% drop in its net income. And revenue from operations came in at 13,718 crore rupees. Anisha is back with us to do the number crunching. Anisha?
Well, yes, Tech Mahindra, the big miss coming is the margin disappointment. The margin has come in at 11.2%, and that compares with the street expectation of 12%. And that's the reason, despite having an inline revenue number, the profitability is lower than expected because the margin has completely missed as far as the street estimate is concerned. The actual on the top line, as far as constant currency is concerned, is a growth of 0.3%. The street was bracing themselves for a decline in the constant currency of anywhere between 0.3 to 0.5%. So better than expected performance coming in as far as dollar revenue is concerned. That gets negated by the margin weakness that I talked about, and that's why the profitability is at around 1150 crores versus the expectation of around 1200 crores. Even if you look at the other internals, my worry is actually coming on the headcount front as well. There's a decline of almost 4,700 employees on a quarter-on-quarter basis, and this is despite the attrition coming down to 15% versus 17%. The pace of deal wins has also contracted. The deal wins this quarter came in at $592 million, and that compares with $795 million last quarter. But that is par for the course, given the fact that the street was ready for that, but the street was not ready for the weak margin performance.
And moving on to some more earnings, banking major Axis Bank also reported a loss of over 124 billion. My colleague Harsh Sayata is here with all the number crunching. Over to you, Harsh.
Well, yes, Axis Bank 11,740 crore is an NII number. It's grown by 33% year on year, slightly lower than what we were projecting. And NIMs therefore have come in fact, lower even sequentially, 4 bips lower. The NIMs. So that's one piece that Axis needs to figure out, because deposit growth has been strong, and probably that is one of the reasons why margins have come in slightly lower. Let's talk about operating profit. That knock-on effect of NII lower has come in on operating profit as well. In fact, operating profit is lower by 1% and almost just above 1% on a sequential basis as well. It's come in at 9,168 crore. So slightly lower than what even we were projecting. But the provisions number has come in at 306 crore versus our estimates of 1,600 crore. And that particular number has aided profitability. Now, there have been some extraordinary items in the profitability. Let me take you through that. 12,490 crore is the effect or impact of Citi acquisition by Axis Bank. And they've accounted for all of those costs, including expense of integration, entirely in this particular quarter. So all of that factored in, it's a loss which stands at 5,728 crore. But when I'm looking at excluding extraordinary items, looking at the profitability, it's come in at around 6,620 crore, which is higher than what we were penciling in. That number has come in quite high, in fact 10% higher on the back of those lower provisions we spoke about. Now let's talk about the balance sheet. Both sides of the balance sheet growing quite well. We've seen a near 20% growth in the advances. We've seen a solid 15% growth on the deposit side as well. Much better than what we were penciling in, but that includes the Citi acquisition. So when I exclude the Citi acquisition, it's largely in line. We've seen around a 16% growth in terms of the advances and around a 12% growth in deposits, largely in line with what we were anticipating. But now Citi's entire balance sheet comes onto Axis Bank. Let's talk about asset quality because that has improved quite well. We are seeing GNPAs come off quite sharply from that 2.46%. They're down just to 2% now. And NNPAs also have come off quite sharply, around 10 bips or so improvement in NNPAs. They've come in at 0.39%. So asset quality, a definite positive. Margins have to wait and watch as to how it goes forward, and the one-time knock-on effect is a positive because that completely eliminates all additional incremental costs of Citi.
Alright, so that's a wrap on Axis Bank's Q4 numbers, and thanks Harsh for taking us through that. But we slip into a very short break. Don't go anywhere. We'll be right back with all the stocks that you should be watching out for in trade today.
Welcome back. You're watching Market Cafe, and it is that time of the show where we get to all the stock-specific action. And for that, we have my colleague Ashesha joining us. Ashesha, tell us what are the stocks that we need to keep on our radars for the trading session?
As a whole host of mid-cap IT companies will be in focus today on the back of their results, and one of them will be LTIMindtree. Revenue from operations in the quarter gone by rose by about 0.8% on a sequential basis. Margins have also risen this quarter. Company has reported margins at 16.4% versus 13.5% margins that the company had reported in the previous quarter. So on the back of results that the company has reported, LTIMindtree will be the first one in focus today. Apart from that, Trent will also be in focus yet again on the back of its results, where revenue from operations rose by a whopping 64% on a year-on-year basis. As far as margins are concerned, they've contracted a tad bit. Company has reported EBITDA margins of 9.3% versus 10.1% EBITDA margins that the company reported in the previous quarter, indicating a contraction of about 80 basis points on a quarter-on-quarter basis. But as far as the bottom line is concerned, company has reported a net profit of 45 crores this quarter versus a loss of 21 crores that the company reported same time last year. So good set of numbers, and on the back of that, Trent will also be in focus today. Let's also talk about GAIL India, and this is because Norges Bank is planning to exclude GAIL from its wealth fund, and Norges Bank holds about 0.9% stake in the company. So on account of these plans of a stakeholder, GAIL India will also be in focus today. Let's also talk about Indian Hotels. Strong set of numbers coming in over here. Revenue from operations have seen an uptick of about 87% on a year-on-year basis. Margins have expanded a whole lot this quarter. Company has reported margins at 32% versus 18% margins that the company reported same time last year. Meanwhile, let's also talk about PI Industries, where the company has acquired two pharma companies to foray into pharma business for about 923 crores. So on account of this acquisition that has come in, PI Industries will also be in focus today. And lastly, Glenmark Pharma, very strong set of numbers over here as well. Revenues are up 21%, margins at 33.7% versus 28% margins that the company reported same time last year. Profit after tax has also seen an uptick of about 50%. So on account of strong set of numbers that has come in, Glenmark Pharma will also be in focus today.
Right, then thank you so much for that, Ashesha. We will be keeping an eye out on all the stocks that you mentioned. Now let's quickly take a stock of where the Asian markets are at. SGX Nifty is at 73 points. It has inched up a little, almost 20 points from the start. And we do have the ripple effect of the Wall Street coming into the Asian markets. All Asian markets are in the green right now. Strong handover coming in from Wall Street. We also have the Bank of Japan policy meeting that will be ending today under the new governor, and the markets are waiting and watching out for that. And on the back of that, Nikkei is up 0.6%. Kospi also in the green, up 0.7%. ASX 200 up 0.4%, and Shanghai, that was very flat at the start of the trade, in the red, has ticked up into the green and is now up 21 points, well into the green now. And SGX Nifty is above the 18,000 levels, also indicating towards a rather positive start for the Indian markets as well.
Alright then, but PI Industries has announced twin acquisitions to foray into the pharma space. My colleague Lisa joins in with more details. Hi Lisa.
Yes, good morning. PI Industries is in focus as they have announced multiple acquisitions into pharma API as well as the CDMO space via its wholly owned subsidiary, which is PI Health Sciences Limited. Well, this ends the long impending overhang that the stock had relating to its foray into the pharma space. Do remember that the company had raised around 2,000 crore way back in 2020 to foray into pharma, and they were going to do it via inorganic route. And during 2021, they also entered into a deal with InSwift Laboratories, but the deal was somehow called off in 2021. But now the company has entered into a definitive agreement with Terachem Research Medilab, and they specialize into rare disease, and also they have entered into SPA with Plahoma 12 GmbH, which for a 100% stake in Archimica Spa. It is an Italian-based small molecule API manufacturer and CDMO servicing in more than 30 countries. Well, the total consideration for this is around 900 crore. And as on H1 FY23, the company had a cash balance of around 2,233 odd crores. So that makes it a war chest of around 1,400 crores still lying with the company, and they can go for further inorganic initiatives. Now, what are the analysts talking about it? They say that the acquisition is likely to take the company to CDMO space, which is an upcoming and also a competitive space. So the analyst wants to know that how the company is likely to scale this up. And also it will provide access to manufacturing facilities in both US as well as India, and any product rollout will expedite faster in these developed region. And also it will nullify the growth concerns that the company was seeing in the CSM business. And the talking about the valuations, the company had acquired these the acquisitions at attractive valuations. So the analyst believes that the acquisitions have been value accretive for the EPS margin and such. So all these factors are expected to be heard from the management. No con call has been announced so far. So well, the market was awaiting this long-term announcement for the pharma space, and now that has been a positive reaction is expected for the company.
All right, then thank you so much for those details, Lisa. Moving on, R.C. Bhargava, who's the chairman of Maruti Suzuki, shares his insight on increasing capacity and margin expectations, along with shedding a light on exports in an exclusive chat with my colleague Sumit. Let's go across and listen in.
Today we are joined here by Mr. R.C. Bhargava, Chairman Maruti Suzuki, on company's new plans as far as new units are concerned, new capacity is concerned, EVs and much more. Thanks for joining us, sir. First of all, I would like to ask you by starting with this question on 1 million extra capacity. That's what you're planning. What is the reason and by when it's expected to come up?
The reason is that our projections of demand going forward till about 2030, 31 indicate that there is a gap in our supply position compared to what we think the demand is likely to grow to be, including the export demand. Because the big difference from earlier times is in the quantum of exports, which we think will happen by 2030, 31. And that change in the export situation is primarily what is driving the need for adding extra capacity.
And so talking about the margins, they are once again above 10% after FY21. Are they sustainable? What about the overall margin picture going forward as far as the profits are concerned?
I don't think anybody can predict margins going forward in any industry. It's just not possible. There are so many variables which are there, and the world today is not a very predictable place. The number of changes and unexpected events which happen are enormous. So please, I mean, I am not at all capable of predicting futures in margins.
So let's talk about chip problem. When last year you suffered chip problem, it was a serious problem that time. What about chip problem going forward? Last year you, in a way, it led to loss of many units. What about this year? Will it be as grave as last year, or are you seeing an improvement when it comes to the problem with chip or semiconductors?
Our expectation is that 23-24 will be better than 22-23 as far as chip availability is concerned. However, this first quarter of this year is still not showing that improvement, but we do expect that from the second quarter onwards, there will be an improvement in the chip situation.
So talking about electric vehicle roadmap, you said that by 2030, 6 more EVs would come. Can you throw some light on your partnership with Toyota as far as EVs are concerned or hybrid vehicles are concerned? And will you partner with other Indian or global manufacturers when it comes to electric vehicles?
We don't have a partnership with Toyota. The partnership is between Suzuki Japan and Toyota Japan. But as a consequence of
All right, so with that, it's a wrap on this edition of Market Cafe. Thanks a lot for watching, but don't go anywhere. The market takes all the action ahead.